Hey everyone, welcome back to the Noob Selling Options channel. So glad you're here. We've got a highly requested explainer for you today. And honestly, if you've been tracking the absolute wild momentum in the tech infrastructure space, you cannot miss this one. We are going to break down the true mathematical reality behind the massive surge we just saw in CRCL or CRCL stock. There's so much hype out there right now, right? But today we're cutting through all that noise together. We're going to use pure objective financial metrics to figure out what this stock is actually worth. I mean, if you were watching the charts yesterday, you saw it happen live. CRCL absolutely rocketed up, over 17%, right after dropping a massive Q1 2026 earnings print. It was just one of those breakout moments that literally forces the entire financial world to stop and pay attention. But look, as investors, a huge spike like that has to trigger an immediate question in your mind. Is this a genuine, sustainable breakout, or is the market just getting way ahead of itself? To figure that out, we have to pull back the curtain. Let's look at the actual underlying metrics driving this crazy price action. So here's our roadmap for today's explainer. First, we'll do a quick CRCL Q1 earnings breakdown. Second, we'll answer the question, what exactly is the PEG ratio? Third, we'll map out the CRCL base versus bull case. And finally, number 4, we'll run some 3-year price projections. All right, let's dive right into Section 1, CRSCL Q1 earnings breakdown. Okay, just look at that number, $21.5 trillion. When I first saw this data point, I literally had to double-check my screen. USDC on-chain transaction volume skyrocketed 263% year over year to hit this mind-boggling figure. I mean, that tells us CRCL's infrastructure is being adopted at a scale that is honestly hard to wrap your head around. It proves, without a doubt, that their network effects are rapidly accelerating. And that massive volume, it translated beautifully across the rest of the balance sheet. Total USDC in circulation hit $77 billion. That's a 28% jump year over year. Adjusted earnings per share came in at 21 cents, which comfortably beat the 18-cent consensus estimate. And adjusted EBITDA grew to $151 million, which means they're operating at a super profitable 53% margin. But I want you to notice that bottom bullet point. Top-line revenue actually missed Wall Street's targets just a tiny bit, and that was mainly because of shifting interest rates lowering their reserve yields. But you know what? The market did not care at all. Why? Because other revenue, which is the money they make from subscriptions and blockchain partnerships, doubled to $42 million. They proved they can grow way beyond just sitting there collecting interest. But here's the thing. The numbers are really only half the story. That 17% surge was fundamentally driven by the narrative. Step 1. Management just absolutely nailed the pitch for the AI agent narrative. They launched the CRCL agent stack, basically positioning USDC as the core plumbing for the new agentic economy. Their vision? They want USDC to be the native, default currency that AI programs use to autonomously execute microtransactions, and Wall Street absolutely ate this up. Then, step 2, massive institutional validation. CRCL announced a $222 million pre-sale for its ARC network token. And look at who backed it. BlackRock, Apollo Funds, and A16Z. Let me tell you, when the absolute smartest money in the room hands you almost $250 million, the entire market sits up and takes notes. Moving right along to Section 2, what is the PEG ratio? So the price to earnings to growth, or PEG ratio, is arguably the single most important reality check for a growth investor. It builds directly on your standard PE ratio, but here's the magic. It actually factors in how fast the company is growing its earnings. Ultimately, the PEG ratio is designed to answer one really simple but absolutely critical question. How much are you paying today for that future growth? It's the tool that empowers you, the retail investor, to look past all the hype and hopefully avoid buying at the absolute top. Let's establish the baseline rules here so you can instantly spot the difference between a bargain and an overpriced asset. The magic number to remember is 1.0. If a stock has a PEG ratio of exactly 1.0, we consider it fairly valued. If the PEG is less than 1.0, the stock is undervalued, meaning growth is cheap and you're getting a deal. But if the PEG is greater than 1.0, the stock is overvalued. You are actively paying a premium. And let's be real, nobody likes overpaying. Okay, let's put this into practice. Section 3, CRCL base versus bull case. So, following that massive 32% overall price spike leading into and following the earnings report, here is exactly where CRCL sits today. The current price is hovering right around $131.76. Now, factoring in their recent earnings beat, the analyst consensus lifts their forward 12-month earnings per share estimate to roughly $1.04. You divide that price by the forward EPS and you get a forward PE of 126x. Just let that sink in for a second. You are paying 126 times forward earnings. That is an absolute skyscraper of a valuation. But the million-dollar question is it actually justified by the growth? Well, let's look at the two primary scenarios side by side. Our base case uses the analyst consensus of 48.4% annualized EPS growth. If you take that 126x PE and divide it by 48.4, you get a PEG ratio of 2.60. Remember our rule from earlier? Anything over 1.0 is a premium, so 2.60, that's a massive premium. But what about the bull case? Aggressive models from places like Zacks project up to 93% year-over-year EPS growth as this whole AI agent stack scales up. But here is the real kicker. Even in that ultra-aggressive, 93% growth scenario, CRCL's PEG is still 1.35. So the absolute crucial takeaway here is that by strict mathematical definitions, even in the very best case scenario, Circle sits uncomfortably above that fair value threshold. And this brilliantly illustrates a core lesson in investing. Strict value theory often really struggles to price in paradigm-shifting technology. So why are investors so willing to absorb this massive premium? Well, because the market isn't valuing Circle as a traditional financial stock anymore. They are currently valuing it as a foundational infrastructure monopoly. Investors are essentially betting that Circle will so thoroughly dominate the AI microtransaction and interoperability space that their future actual earnings will just completely obliterate today's Wall Street projections. Basically, they're paying up for monopoly mode. This brings us to the final piece of the puzzle, Section 4, 3-year price projections. We have to bridge the gap between today's growth at any price sentiment and the cold, hard math of earnings compounding. Let's use our base case of 48.4% annual growth starting from today's $1.04 EPS. By year 1 in 2027, EPS compounds to $1.54. By year 2, 2028, it grows to $2.29. And by year 3, 2029, Circle is generating a very healthy $3.40 in earnings per share. Make no mistake, that is fantastic execution perfect growth. But here is the tricky reality of investing in hypergrowth stocks, PE compression. A company simply cannot maintain a 126x multiple as it gets larger. Eventually, financial gravity takes hold. Let's multiply our 2029 EPS of $3.40 against 3 future PE scenarios. In the fair value mean scenario, where the PEG reverts to 1.0, it settles at a 48x PE. That gives us a price target of $163.20. Now, if they maintain a moat premium as a market leader, settling at a 72x PE, our target jumps to $244.80. And in the absolute AI fortress bull scenario, where institutional demand just remains totally manic at a 96x PE, we hit a price target of $326.40. Now, I really want you to look closely at the sobering math of that base case. If you followed the base case PEG theory strictly, expecting the multiple to normalize down to 48x as the company matures, your 3-year price target is $163.20. Let me put that into perspective. If you buy today at $131.76, paying that 126x multiple, you are basically setting yourself up for an incredibly limited 24% total gain over 3 whole years. And this brings us to the ultimate question, what we call the valuation trap. Even if Circle executes its business plan perfectly and grows its earnings by over 200%, will a normalizing, compressing valuation ultimately cannibalize your stock returns? It's a fascinating dilemma, right? You've got an incredible company, but a very, very expensive stock. I'd love to know where you stand on this. Let me know your thoughts in the comments below. And hey, if you found this explainer valuable, please hit that like button and subscribe to the Noob Selling Options channel. Until next time, stay focused and trade smart.